Hey everyone, welcome. So let's talk about something that affects a ton of business owners, your vehicle. You're using it for work, you're racking up expenses, and you know you can save some real money on your taxes. But here's the big question. Are you actually getting it right?
Well, that's exactly what we're going to tackle in this explainer. We are diving straight into the official Canadian tax guidelines to make sure you can confidently claim every single dollar you're entitled to. No more guesswork.
All right, to keep things super clear, we've broken this whole thing down into 5 key parts. We're going to start with the rules for vehicle loans, and then we'll get into the nitty-gritty of leases, which, trust me, can be a little more complex. You ready? Okay, let's jump right in. Okay, first up, loans. So, you went out, you borrowed money to buy a vehicle for your business. That's great. You can absolutely deduct the interest you're paying. But, and you knew there was a but coming, right? There is a limit, a cap on what you can claim, especially when we're talking about passenger vehicles. So what's the magic number? How much can you actually write off? Well, it's not just one number. It's kind of like a showdown between two amounts. On one hand, you have the total interest you actually paid all year. On the other, you've got a daily rate that the government sets. The rule is simple, but it's super important. You can only claim the lower of those two. This is basically the government's way of making sure the deductions stay reasonable, you know? And speaking of that government rate, let's zoom in on this number right here, $11.66. Now, that's the daily rate for vehicles bought after 2023. But, and this is a really crucial detail, this rate isn't set in stone. It changes. If you bought your car or truck before 2024, the rate was actually lower. So you've absolutely got to make sure you're using the right rate for your vehicle's purchase year. All right, so that's the theory. We get the concept. But how do you actually apply all this during tax season without, pulling your hair out? Let's take a look at the tool that makes it happen. You'll be happy to hear that you don't have to do this all in a napkin. The Canada Revenue Agency, the CRA, gives you a specific worksheet. It's called Chart B, and its entire purpose is to walk you through this exact calculation, step by step. It basically forces you to compare the two amounts and ensures you claim the correct, lesser figure. Honestly, it's a real lifesaver. Okay, so that's the deal with loans. Pretty straightforward once you know the rule, right? But now, let's switch gears and talk about leasing a vehicle. This is where things can get a little more, let's say, interesting. But don't you worry, we're going to break it all down. So just like with a loan, you can definitely deduct your leasing costs. You'll find the specific spot on your tax return, whether it's for business, farming, or fishing. But, and you can probably guess what's coming next, just like with the loan interest, there's a limit on how much you can claim for a passenger vehicle. And how do you figure out that limit? Well, you'll need another official worksheet. This time, we're looking at Chart C. Think of Chart B and Chart C as your two best friends when it comes to vehicle deductions. Using this chart is absolutely essential if you want to get your leasing deduction right. Okay, as we go through this, you're going to hear a specific term pop up a lot, prescribed amount. It sounds a little, official and intimidating, but all it really means is a number that's set by the government, written into the tax law. It's not something you can negotiate or estimate. It's a hard and fast rule, a fixed number. Simple as that. Yeah, this is the part where theory can get a bit foggy. So I think the best way to understand this is to just walk through a detailed, real-world example. We're going to see exactly how Chart C works in practice. Seeing the actual numbers in action really makes it all click. Okay, let's bring this to life with a story. Meet Meadow. She's a smart business owner, and on July 1st, 2024, she started leasing a new car for her work. Now, on the screen, you can see all the key details. We have her real-world numbers, like her $500 monthly payment, and right alongside them, you see the government's prescribed limits for that year. We're going to use all of this to figure out her deduction. So what Chart C really does is it boils everything down to 3 main steps. First, we calculate one potential limit. Then, we calculate a second, different limit. And finally, the last step is just to compare those two numbers. It's all about finding the right cap for her situation. All right, step 1, we plug Meadow's info into the first formula on Chart C. This formula uses things like that prescribed monthly lease limit and the number of days she actually had the car. After we crunch the numbers, it spits out our first potential limit, $7,277. Okay, but we're not done. Now we move on to step 2, which uses a completely different formula. This one takes into account the vehicle's prescribed cost limit, what the manufacturer's list price was, and the actual cash Meadow paid for her lease during the year. And this calculation gives us our second potential limit, $3,000. So now we have our two numbers, 7,277 and 3,000. And here's the crucial point, the golden rule we keep coming back to. Meadow's eligible leasing cost, the amount she can actually deduct, is the lesser of those two. It's the exact same principle we saw with the loan interest. You always take the lower number. So when we put them side by side, it's a no-brainer. Her allowable claim for the year is $3,000. This example is perfect because it shows so clearly how those prescribed limits can have a massive impact on your final deduction. Even though one calculation was over $7,000, the rules capped her at less than half of that. Okay, now just when you think you've got this all figured out, the tax code throws a little curveball at you. There is a key exception, a special situation where you cannot use the standard Chart C calculation. And you really need to know about this, because getting it wrong could be a very costly mistake. This little twist in the rules revolves around something called imputed interest. I know, another fancy term, but the idea behind it is actually pretty straightforward. It's all about large, refundable deposits. If you give your leasing company a big chunk of cash as a deposit that you'll get back later, the government basically says, hey, wait a minute, you could have been earning interest on that money yourself. So they want to account for that potential interest you lost. So, how do you know if this applies to you? Well, you have to check 3 boxes. 1. Did you make 1 or more deposits? 2. Is at least one of those deposits refundable? And 3. Is the grand total of all your deposits more than $1,000? If you answer yes to all 3 of those, then stop. You cannot use Chart C. You have to use a completely different calculation method. Whew, okay, that was a lot, I know. So let's just quickly recap the absolute key takeaways here. First, always be aware of the government's prescribed limits for passenger vehicles. They are the ceiling on your deductions. Second, use the official forms, Chart B for loans, Chart C for leases. They are there to help you, so use them. Third, remember that golden rule. Your deduction is the lesser of the calculated limits. And finally, keep an eye out for those special conditions like that whole imputed interest thing, because they can totally change the game. And all of this brings us right back to our big question at the start. Are you maximizing your vehicle deductions correctly? The rules might seem a little complicated at first glance, but taking the time to understand them, to really get how they work, means you can file your taxes with confidence. And more importantly, it can put real money back in your pocket.